So welcome to part 2 of frequently asked questions for small businesses.
Part 2. Part 1 just ended 5 minutes ago, just so you guys know.
It's too long, so we decided to cut it short.
Yeah, pretty much. So let's jump into it. Okay, what is our question? Our first question of part 2 is, should I open a business bank account? Can I just use my personal bank account instead?
Yeah, so for every single entity you have, definitely open out a separate bank account.
Yeah, so why though? Why can't we just use our own personal bank account for the business?
Accountants always rely on the bank statement to lodge your taxes. And if all your different entities' bank transactions are in one statement, it will be in the onus of the owner or the director to go through each and every one of the transactions and tell the accountant which entity it is for.
Yeah, so basically, for example, if you had one bank account and let's say that bank account had your personal transactions, your gym fees, your Uber Eats fees, your expenses, and your business expenses, your business income, and as well as your mom and dad's income, and then your partner's income and expenses, everything in one bank account. When you do your bookkeeping, you're supposed to connect your bank account to the accounting software. That means that you only have, let's just say 20-30% of those transactions as business transactions. But now you've got 60 to 70 of those other expenses as personal, so they're not really related to the business, and we gotta extract that data out. And then leave it alone, basically. But that requirement of extracting that data and going through it takes a lot of time. And what do you think happens when it takes a lot of time?
So we have to charge you more.
Yeah, so the bookkeeper or the accountant will charge you more as a result. And that's where, like, you know, a lot of clients come to us and they say to us, like, why is our accounting fee so much? It's because your goddamn bloody bookkeeping work is so crap. Like, it's like we can't fix it. We have to fix it. And there's no way that you're gonna do it. So therefore we're gonna charge you for it. We have to. Because if we don't charge you for it, we can't get that data out. And yes, you didn't make that much money or you didn't have that many transactions. But we have to go over every transaction and then find out what's personal and what's business. Yeah. And my pet hate is like another thing, which is like not having the business bank account, but having an accounting software, but having all your bank accounts in the accounting software, your personal one, your other businesses, you know, you have like XYZ Pty Limited company bank account in there, but then you have ABC Pty Limited in the same bank account, in the same zero file. That's where it confuses everything as well.
For those people at home who have friends who are accountants or bookkeepers, this is the reason why they can't sleep at night. This is our nightmare.
Yeah, we've stayed up. We've done a few lack of sleep because we're either trying to fix a client's accounting software or fix this client's bank account or try to lodge a tax return, and we just have to go through some funny things. Come on, guys, like, do you really want your accountant to see what you spend personally? Like, do you want us to know how much you eat? Like, do you want us to see what you want to hide from your wife? Because I've seen some funky stuff, mate. So have a business bank account so you don't need your accountant to see all that stuff. Like, you have a business bank account, all your business expenses go in, all your business income goes in there, then squeak it clean, then your accountant can lodge your taxes. If you want to hide some stuff with your accountant, then you can hide some stuff in your personal bank account. We don't need to know about it, right? So I'm not telling you to hide anything. You should tell me everything. Cool. All right.
So the next frequently asked question is, what insurance do I need?
If you're running a business, then you'll need multiple business insurances, and it depends on what you actually do with your business. So for example, if you're employing employees, if you're in a specific trade, for example, if you're a builder, then you'll need specific insurance for builders, and they called homeowners warranty or home builders insurance, which is basically if you build, it's insurance to cover for your work. But then there's also, if you employ employees, there's workers' compensation, and every state has a different insurance authority, so you have to speak to the state. I know New South Wales has iCare. I think Victoria is called WorkSafe. So it just depends on that. If you're renting a commercial practice, like a company, and you're like an accountant and you have an office and you're renting an office, you may or may not need public liability insurance. And that's just to cover you if someone hurt themselves at your office. But just so you know, sometimes your landlord might have that insurance already, so you might not need it, but you sometimes do need it. Is there any other insurances you might need?
So there is cybersecurity insurance. That's a big one.
Yeah.
Because at this day and age, your client's data is huge. Like, you know, if you get hacked and stuff like that, the liability that your company it can be under is going to be
so
very big.
we've got we've got like multiple videos about insurances, and it's really important because it can make or break your business. So cyber insurance is a big one, especially for the lawyers out there. Like, you know, the legal practices, we hear all these stories where lawyers' office gets hacked and an email gets sent to a client to say transfer this money over to you know, this bank account for the settlement, and they transfer the money and then poof, $1 million gone like that. So cyber insurance is really important. It's not compulsory though. You don't have to get it. Some insurances aren't compulsory, and a lot of people think that insurance is like so expensive, I'm not gonna go get it. There's some insurances you just need to get, and it's because the consequences are so significant that could really make or break not just your business, but your family as well. So that's another thing, personal insurances. What type of personal insurances are there?
The common ones is life insurance, life, death, and TPD insurance, trauma insurance, and the one that is tax deductible is income protection insurance. And of course, you got your general health insurance. What if I want to wrangle it up a bit? I'm a cowboy, I'm going to take the risk, and I want to purchase the minimum level of insurances. I want to save as much money for my business to run my business. I don't want to be spending it on insurance premiums. What insurances must I get?
Well, okay, so firstly, if you're running a business and you actually have a premises, like an office, then you need to get public liability because your landlord will probably ask you to get one. If you employ employees, then you will need to get workers' compensation insurance. That's the bare minimum. And the way it works is that you declare the amount of wages that you think you might have for the whole year, and then you pay a premium. And then at the end of the year, they do an actual wages form, and you fill that out, and then you pay the difference if there is it, if your wages are higher, or you might get a refund. There's asset insurance. Asset insurance sounds confusing, but it's actually you just insuring specific assets, like car insurance is one of them, and that's compulsory.
And the one that Box Advisory really needs, because they're hiring people like me, is professional indemnity insurance.
Yes, that's a good one actually. I forgot about that one, which is, professional indemnity insurance is a big one. So depending on what you do, that might be compulsory for you because your association that you're part of, for example, us, we're part of the CA and we're part of the Tax Practitioner Board. As a tax agent, we need to get professional indemnity insurance because if something were to happen to our clients or because our advice was incorrect, which we've thankfully never need to use it, which doesn't mean that you can sue me, but basically means that we're covered by the insurance if something bad happens. So, you know, it doesn't just make or break our family, but it also doesn't make or break our client's family as well. So it's really important to get that type of insurance. So you are right. Like they're the type of insurances. Is there anything else that's like that you might need that's compulsory?
Yeah, I think that covers that.
Yeah, private health insurance.
Yeah, private health insurance.
Yeah, so that's not really a business insurance, but you might need private health insurance, hospital cover. There's a difference between hospital and extras. So hospital cover is just to cover yourself, and it's just one thing that the government's trying to do is if you earn a certain amount, which is over $90,000 or 180K as a family, if you earn over that amount, that means that they don't want you on the public health system. So they want you to get your own insurance cover to cover yourself. So they have the public health system for, you know, the lesser fortunate people that don't have the money. So the point is they're trying to encourage you to get hospital cover, private health insurance, so you can get off the public health system. And that's the point of Medicare levy, they call it. So if you don't go and get the hospital cover, you get charged a certain percentage extra on your tax returns, and that happens to the whole family. So it's really important to look at that.
Yep. So let's move on to the next question. And this question causes a lot of business owners anxiety because they have a bunch of money sitting in the company bank account and they're like, can I actually touch this money? So the next question is, how do I pay myself?
How do you pay yourself? How do you take money out of the company or the business? You know, can I take it out? That's one thing. The good guys actually ask this question. The bad guys, they've already taken the money out and ran for their life and haven't paid any tax. So why do you have to ask that question? It's because the business is separated from you. It's only when you're a sole trader you don't really have to worry too much about it. But if you're a company, you're a trust, you're running a business for a company or a trust, it means that it's a separate legal entity. So therefore you can't just go taking money out. You actually have to do something about it. And there are 3 ways to take money out?
The 3 ways are director loans, dividends, and wages.
Yes.
So to break it down, director loan is simply what it means. The director takes a loan from the company or lends money to the company.
So director loans, you'll see it in your accounting software as either owner drawings, owner contribution, or director drawings or director loans. Basically, that's just money that you're taking out of the company and you haven't treated it as a dividend, wage, or salary, and that's where it gets treated as a loan. But there are problems with that, right?
Yep. So think about director loans as the most flexible way in the short term to take money in and out of the account. So if, for example, you took the bank card and you went to buy yourself a Gucci handbag, which is completely not relevant to the business.
Yes.
So where would you code that? You would code that to a director loan because what you have essentially done is you have taken company money, you have borrowed from the company, and you have bought your own personal asset.
You can treat it as like, fringe benefits, but then there's a huge amount of tax you have to pay as a result. So a lot of business owners would then treat it as like, personal drawings, and that results to director's loan. And that's a big problem because the tax office sees that as you haven't paid the tax on that money that you've made in the bank account of the business, and then you've already taken it out. So that's where they have a problem about that. So they can tax that amount, and they call this Division 7A. Very, very confusing. I did a video about this to talk about that, but basically, director's loans are a short-term thing. You've got to deal with them, and you've got to deal with them before the financial year ends. And it's always good to speak to the accountant about that. So there are other ways. Let's talk about wages and then dividends.
So wages is your pay slips. There are 3 components of wages. There is your gross wage, there is your tax, so the tax is going to be called PAYG, and there is your superannuation contributions.
Then you lodge single touch payroll and you calculate that on your accounting software. So you can't really calculate that yourself anymore. Back in the day, you could probably do that. Like you can get a tax table that the ATO gives you, and then you just go over the table. The table is like 20 pages or something like that, depending on how much money you make, and then you look over how much the gross amount is per week, and then you look over and then you find the tax, and then you take out the tax and you pay out the gross to yourself. We always recommend to our clients to pay some sort of wage to themselves. Why do we say that? It's because you're running a business, and a business needs to pay employees, right? So if you're putting your hours, even your man hours, into the business, you should be rewarded for it. And if you don't reward yourself and you just keep all the money in the company, sounds great and stuff. There's a lot of money in the bank account of the company, but then you can't have money to survive. So you need to pay yourself something, right? And on top of that, you want the business to be successful on its own right, not just you putting in all the effort for free. Because eventually, one day, you're gonna hire people to replace you. And you need to make sure that you can afford that. That's one thing. And 2, you gotta survive. And 3, it's actually tax effective to pay yourself a wage. Like it actually is. So why not do it? So we always recommend to our clients, pay some sort of wage. You don't have to do it straight away though, right? You don't actually need to from day one pay your wage. You can start back paying yourself after 3 months or 6 months when you realize that you're actually making some sort of money and you reward yourself. Yeah, cool. Yep. So that's wages. What about dividends?
So dividends are, if you have bought shares, you probably would have seen this before. They pay you out a franked dividend or an unfranked dividend. Dividends are distributions that the company makes to the shareholders and is in proportion to the amount of shares held by each shareholder.
So that's how dividends work, but you have to make a profit. So you can't pay dividends if there is no profit in the business. So that's sometimes like, when you first start a business and there's money in the bank account and you want to kind of take it out, you got to think about, can I really actually pay myself a dividend even though there's no profit in the company? So you got to be careful, and people just go, oh, how do I even pay a dividend? Speak to the accountant basically, right? So the accountant is supposed to work that all out for you.
Yep, and the accountant would have to create a dividend statement for you to withdraw the dividend.
Yeah, cool.
And there's another part of dividends which is called franking credits. So when you pay out a dividend, you could either pay out a franked dividend or an unfranked dividend. Mostly companies will pay out franked dividends. And what franking credits are, essentially, they are to prevent the individual or the director from being taxed twice.
Yeah, the shareholders. Yeah.
The shareholders from being taxed twice.
Yeah.
So you would get taxed at the company tax rate at 25%. If let's say your marginal tax rate for your individual is 37%, you just have to pay 12% on top.
Yeah, so basically, let's use the example that I was saying about the 100K. So for example, let's just say that we've paid 70K to myself and 30K to yourself. This is very basic, yeah? It's more complicated than this, but 70K went to me and my tax rate is 45%. And then, 30K went to Sean and his tax rate is 32.5%. That company profit that we've received of that 100K, there's already tax that's been paid on it. So tax of 25% has been paid on that $100,000 and the leftover amount was 100K. So that's where we split the 70K to me and then 30K to Sean. My tax rate is 45% in my personal name. So that's 70K, there's already 25% of tax paid on it. So I have to pay the top-up tax. And that's roughly around 20% because 25 minus the 45% is 20%. Yeah, am I getting it right?
This tough for accountants. Accountants are not good at math. Let's
right,
get
right?
that straight.
25 minus 45, yeah, that's 20%. Yeah.
That's 20%, but you took so long, man. Like,
I'm just like making sure I said the right thing. But yeah.
All right.
And then for Sean's one was 32.5. Now this is the hard one. 32.5 minus 25 is 7.5%. So you have to pay 7.5% extra. So that's how franking credits work. Yeah. And then unfranked means that the 100K hasn't been taxed at all. So therefore, you don't pay a top-up tax, you pay the full amount of 45% in my name, and you pay the full amount of 32.5 on your 30% share of the dividends. Yeah, and that's kind of how it works. It's very confusing, but we always say to our clients at the start, don't need to pay yourself straight away. You can draw some money out from the company or the business as a director's loan for now. After 3 months, 6 months, once you've worked out that you've made some profit, then you can start thinking about and speaking to your accountant on what type of wage you should pay yourself. Then you need some sort of accounting software to make sure that you record your pay slips right, do your single touch payroll, and then pay yourself regularly. We live in a society that is very old school. When they see a business that you're running, a company, they will want to see wages. Like they want to see weekly or monthly payments to yourself because it makes sense, So it's important that you consider paying yourself a wage because it helps you in the long run. Cool. All right. Next and most common question, number 1, right?
Number 1.
How do I minimize my tax?
Okay, so before we answer this question, it's always good to think about your objectives. Do you want to get a loan? Minimizing tax is not always in the best interest of your business or your personal objectives. If you want to get a loan, you will have to show profits in your company account and therefore you will be taxed at a higher rate. But if that profit could reduce your interest rates in the loan because you're showing more profits, then you could overall have a net surplus in cash.
How does the profit reduce your interest rates? What do you mean by that?
So for example, if you show a solid year of profits, then the banks would feel like you're a safer business to borrow money to.
Yeah, so therefore they give you a lower.
So
they'll give you a lower interest rate as a result. So yeah, that's how the banks work. They lend money and they make money through the interest. So they take money from other savers, like you've got money in your bank account and you get interest. They need to pay these people that have given them money interest. And then what they do is they kind of do arbitrage. They go ask people who wants to take a loan and they charge a bit higher interest, so therefore they make a profit on the side. So that's how banks make their money. And then how do they work out the interest rate? They work out the interest rate, this is the most simple explanation, but the banks work out the interest rate depending on how risky that borrower is. If you don't make profit or you make a very low amount of profit, they think you're more high risk. So therefore your interest rate is higher. Yep.
But okay, you're like, Sean, I don't care about financing, I just want to reduce my taxes. Sure, the first thing that the accountant will look at is your structure. So if let's say you're in a company, we'll look at the numbers and think about how much wages should we pay you? How much wages should we pay, let's say if your spouse is a director of the firm as well, how much wages should we pay your spouse? If let's say your company has a trust attached, which beneficiary has the lowest tax rate and which beneficiary we should distribute the funds to?
Yeah, so there's a lot of ways to minimize your tax and we're using structures, like different types of structures, different types of entities to minimize your tax. So if you had all the income going under, like my name for example, we're going to pay 45% in taxes. But if we can spread the income over a bunch of entities where, a spouse, working spouse, it has to be a working spouse, obviously. Like the spouse has to be working in your business. Like your directors, then the shareholders, the bucket company or super fund. That's where we can actually minimize the taxes. So there's a bunch of ways to do it. One way is structuring. So structuring is a big thing, and sometimes you do it at the start, sometimes you do it in the middle, and then sometimes you do it at the end as well. So yeah, that's basically one way of reducing your taxes.
Yep. And then on top of that, we'll look at if, let's say, you are doing a accrual basis tax return, you would look at all your invoice to customers, you would look at them and feel like, oh, okay, this customer is probably not going to pay it, and you're going to write off all your bad debt.
Yeah, so the next step is actually looking for tax deductions. Like what type of tax deductions that we can claim that they call this non-cash adjustments in what us accountants do. So obviously you can claim all these tax deductions that you've actually physically spent. So buying a car, buying a computer, paying for repairs and maintenance, that stuff we see in your bank account, we already claim it, that's your P&L. But then us accountants, we come in and we look for non-cash adjustments that we can make that can reduce your taxes as well. And what Sean's saying is an example of a non-cash adjustment, which is looking at your bad debts and your invoices that haven't been paid and removing those because you're not going to receive the money anyway, so you can claim a tax deduction for it. There are other types of non-cash adjustments. You're talking about depreciation, that's one. Yeah, so non-cash adjustment is depreciation where you've already spent that money, but you get to claim it over the life cycle of the asset. So you can claim, sometimes 100% of your assets. What do you know another non-adjustment?
So you could use a diminishing value where it's claimable upon a percentage. And I like how Davie is testing me on the fly here.
Nah, it's just we mentioned one, which is interest. Interest is one that is a non-cash adjustment where we pay for a loan, we can't claim the loan, but we can claim the interest, which is a non-cash adjustment. So there's a whole bunch of them.
And in terms of adjustments, and you spoke about depreciation just now.
Yeah.
It goes back to the first question: what are your goals and objectives, and what's your business plan? And that's why we call it tax planning. Because on some years you want to show a larger amount of profits, and for some years you just want to save on taxes. So depreciation is a very good way to adjust and plan your taxes. So for example, you can choose to write off your entire vehicle using the instant asset write-off.
Yeah.
Or you can choose to write off the depreciation of your vehicle using a percentage basis. That's called a diminishing returns. And there's one more, which is a straight line depreciation. And then on top of that, you can plan your expenses as well. You can prepay your expenses for the following year. You could look for all your suppliers and say, hey, I'm making a lot of profits this year. I want to prepay you first so that I can bring up my profits.
Yeah, so there's multiple ways, and that's the way where you have to spend money to reduce your taxes. But the way you got to look at it is don't go spending too much money, then you reach cash flow issues. The point is look at what you're going to spend on anyway, and you're going to spend it, and you have the money in your bank account. Don't go and spend it. There are other ways to minimize your tax. There's non-tax deduction ways, which is organizing a payment plan and then extending your tax bill over time rather than paying it straight away. Oh yeah, superannuation was one that we talked about. You can just contribute more money into super, and that's you spending more money. But the good thing about doing that is that then the tax rate in your super is 15%. Yeah, man, that's pretty much most of the ways. The main thing is that you need to speak to your accountant before 30 June hits. That's the problem. I find that a lot of the clients and small businesses, they ask for the tax, what to do with the taxes after 30 June when the date's passed. So you can't really make any adjustments. You only can make adjustments for the non-cash adjustments, but all the cash adjustments, you can't make it anymore.
Yeah, absolutely. Definitely speak to your accountant earlier than later, because that would bring a lot of benefit. Accountants can only work their magic when the event hasn't occurred.
So basically, speak to your accountants before 30 June. We usually recommend to our clients that we should speak to you about May or June, but obviously get your books up to date because accountants can't really do anything unless the books are up to date. Yeah. So off to the next question.
So Davie, how dodgy are you?
We do get asked this question. We're not dodgy, mate. Not at all.
Not at all.
Yeah. Okay, so just record this and then send it over to the ATO and let the ATO know that we're like, squeaky clean. Yeah.
Squeaky clean.
Yeah, so, us accountants usually call this creative accounting. Look, man, like I think we're pretty clean. Like I don't think we're dodgy at all. And we always tell our clients, we're ethical accountants. We're chartered accountants. We've, studied the law. I've been doing this for 14 plus years. I'm not gonna go and try to dodge tax and do the wrong thing when it comes to the ATO. We don't work for the ATO, but we want to do the right thing and we want to protect you as a business, because the more dodgy you are, more likely you'll get a tax audit.
Yeah, absolutely.
And if once you get a tax audit, it's going to cost you more money because one, you're going to get penalties. Two, you're going to get more accounting fees, and then three, it's just going to cause you a lot of heartache and headache.
I think on the spectrum of conservative and extremely dodgy, we are probably in the middle, right? Because, some accountants are a bit too conservative and they really don't want to do anything, that we would call creative accounting and all these kind of things. And in my opinion, the law is written in a way where there are areas where you can put it to the client's benefit.
That's the point. Like, the tax law is written in a way where if you're running a business, you can claim tax deductions. If the tax deductions are related directly to your income and how you generate the income, then you can claim it. We give our clients strategies and ways that they can minimize their tax. Obviously, we follow the law, we read the law, we study the law, and we abide by the law. But like you said, like we're in the middle. We make sure that we work for the clients. That's the main thing. We help the client achieve their goals, whether it's to get loans, pay more tax, or whether it's like try to minimize the tax. But we never go and overstep the boundaries where we go into red zone where we're considered like where it's considered illegal, basically. Yeah. So. But I really can't stand this question. And when some clients ask me this question, like I just go, man, is that how you think an accountant is good? Because if that's how you think an accountant is good, then you don't know what accounting is. Yeah. So don't ask me that question. Just know that I'll take care of you. Can you hear that? Nah, we're just joking. We're joking. We're law-abiding citizens. All right, guys. So that's pretty much the finale of all the frequently asked questions that we have. We're probably going to do this more often once we have more common questions. Maybe we should do one about dumb questions.
There are no dumb questions.
Yeah, there isn't. There is never a dumb question. You can ask us any questions whatsoever. So ask away in the comment section and we'll answer it. So yeah, go for it. I think it's good that we educate you guys and explain a bit about what we say to our clients, because it's quite important. So if you don't have an accountant that explains things like the way we explain it, find another accountant, right? Or who should they find? Box Advisory Services. Mr. Shawnee. All right, see you guys later.
See ya.